Florida's condo boom created an unstoppable frenzy. 330,000 newcomers, record prices soaring above $410,000, and a governor eager to claim credit for building a paradise. But in 2025, as buyers flooded out and condo contracts collapsed overnight, it wasn't just the market that cracked, it was the governor's composure. Now, with Hurricane Erin threatening to shatter what's left, hundreds of millions in home values and thousands of livelihoods are on the line. Why did Florida's hottest dream turn into a nightmare almost no one saw coming? The real unraveling starts right here. Sun, palm trees, and a line of moving vans stretching across I-95. In 2021, South Florida became the finish line for America's restless millions. Families, retirees, remote workers, and investors all chasing warm weather and a promise of low taxes. The numbers told the story. Florida's population surged by more than 220,000 that year, with Palm Beach alone adding over 16,000 new residents. Miami-Dade and Broward, always magnets for international arrivals, saw steady gains from abroad, even as some longtime locals packed up for Georgia or Texas. For every U-Haul rolling in from New Jersey or Illinois, another condo went off the market. Developers hustled to break ground on new towers, but demand outpaced supply at every turn. Listings vanished within days. Bidding wars erupted over two-bedroom units with ocean glimpses, and cash offers started to crowd out first-time buyers. In some neighborhoods, the total number of homes for sale dropped by half in less than 12 months. By the end of 2021, the state's population topped 22 million, a record high. Miami's international airports buzzed with new arrivals, while moving companies struggled to keep up with the flood of inbound shipments. Palm Beach County's schools added portable classrooms to accommodate the influx. Restaurants hired in droves, and even the smallest strip malls found themselves with full parking lots. This migration wasn't just about numbers. It reshaped the local economy. Real estate agents juggled dozens of clients at once. Contractors and tradespeople fielded months-long backlogs. Grocery stores expanded their hours. And traffic on I-95 slowed to a crawl during rush hour. For the first time in decades, South Florida's housing demand felt limitless. Behind every closed sale, a new story began. Remote workers setting up home offices with ocean views, retirees finally trading snow for sand, and investors betting that the boom would last. All of it fueled by the simple math of more people chasing fewer homes. The pressure built, and prices started to climb, setting the stage for a market where expectations and anxieties would soon outpace even the wildest projections. By the close of 2024, the South Florida condo market looked unstoppable. Median sale prices soared past $410,000, a 19% jump from the year before, outpacing wage growth, inflation, and even the most bullish forecasts from national analysts. In Miami Beach, the average two-bedroom condo, once a $350,000 starter home, now fetched over $600,000. Bidding wars erupted before listings even hit the MLS. Agents fielded calls from hedge funds and overseas buyers, wiring deposits sight unseen. Some buildings posted wait lists longer than the amenities list. In Boca Raton, a penthouse that closed at $1.2 million in 2022 resold for $2 million just 18 months later. The frenzy drew national headlines. Morning shows broadcast live from pool decks, touting the region as the last great boomtown. The governor, never far from a ribbon cutting, presided over photo ops at new luxury towers, touting record job growth and home values as proof that Florida had cracked the code. Developers paid for skywriting campaigns and sponsored influencer tours, promising buyers a slice of paradise with every closing. Billboards along I-95 read, "Your dream home awaits, but not for long." On the ground, the numbers told a story of excess. Cash offers accounted for nearly half of all condo sales in Miami-Dade by December. Investors snapped up entire floors, planning to flip units before the paint dried. In Fort Lauderdale, more than 70% of new listings sold above asking, with escalation clauses pushing final prices higher by the week. Local buyers, locked out by soaring costs, watched as out-of-state money drove up values and shrank inventory to record lows. The press called it a gold rush, but for every headline about a record sale, there were whispers of risk. Debt-to-income ratios stretched thin, appraisals lagging behind contract prices, and a growing reliance on adjustable-rate loans to make deals pencil out. Still, the party rolled on. Open houses drew crowds that spilled into the street, and even the governor's social feeds brimmed with images of ceremonial shovels and congratulatory handshakes. For a moment, it felt like the boom would never end. 6 insurance carriers failed in Florida between 2022 and 2025. Each exit announced with little warning, each collapse sending shockwaves through the market. United Property Insurance, once one of the largest on the coast, withdrew from South Florida in August 2025, just weeks before hurricane season's peak. Their departure left more than 30,000 policyholders scrambling for alternatives, many forced to accept bare-bones coverage, or risk going uninsured entirely. By the time the dust settled, more than 600,000 homeowners statewide had lost their private coverage in less than 3 years. The dominoes fell quickly. After every carrier exit, lenders tightened their rules. Mortgage approvals stalled if buyers couldn't produce a valid policy. Condo closings froze mid-escrow, with some buyers losing deposits as high as $20,000 when deals unraveled. Agents and attorneys fielded panicked calls from clients suddenly uninsurable, forced to shop a shrinking list of specialty brokers with even stricter requirements. In Miami Beach and Fort Lauderdale, entire buildings found themselves blacklisted, unable to secure master policies at any price. Insurers blamed mounting losses from hurricanes, the rising costs of reinsurance, and a wave of lawsuits over roof claims and water damage. Each crisis year, the state's insurance regulator held emergency hearings, but the exodus continued. Carriers that stayed demanded higher deductibles, windstorm exclusions, and stricter inspection rules. For condo boards, the annual renewal became a guessing game. Would they get an offer at all? And if so, at what cost? The private market's retreat forced thousands into Citizens Property Insurance Corporation, Florida's state-run backstop, meant for emergencies, not the day-to-day business of insuring the bulk of the state's homes. By mid-2025, Citizens covered more than 1.3 million properties, nearly 1 in 8 homes statewide. That pool of risk grew with every carrier failure, stretching the system and raising the specter of surcharges on every policyholder if a major storm hit. The rules had changed overnight. Where insurance had once been a formality at closing, it was now the single biggest obstacle to buying or selling a home in South Florida. Buyers and sellers alike faced a new reality. Coverage wasn't just expensive, it was vanishing. Insurance premiums in South Florida are rewriting the rules of homeownership. The average annual cost for a homeowner's policy in Broward now stands at $6,291, more than double what buyers paid just 3 years ago and nearly 3 times the national average. For many, that's another mortgage paid to insurers with no ceiling in sight. Miami-Dade isn't far behind. Condo owners there face yearly bills of $6,170, with some high-rise associations passing special assessments just to keep their master policies active. These aren't optional expenses. Lenders require proof of coverage before closing. And any lapse means deals fall apart, sometimes days before move-in. The private insurance market's retreat has forced a mass migration to Citizens Property Insurance Corporation, the state-run backstop originally designed for emergencies only. By mid-2025, Citizens covered over 1.3 million homes, nearly 1 in 8 across Florida. That pool grows with every carrier exit, stretching resources and raising the risk that a single major storm could trigger surcharges for every policyholder in the state, not just those in Citizens. For buyers, the math is brutal. Premiums now swallow a larger share of the monthly payment than property taxes in many neighborhoods. Condo associations, already squeezed by new safety mandates, pass rising insurance costs directly to residents. Special assessments of $5,000, $10,000, or more have become routine, with some owners forced to sell rather than pay. The pain isn't limited to the closing table. Each renewal season brings fresh sticker shock, and every hurricane forecast sends rates higher. Some buildings, especially older ones near the water, can't find coverage at any price. Their units sit unsold, even as inventory piles up across the Tri-County region. Buyers who once dreamed of a second home or investment property now face premiums that erase any hope of profit. For families stretching to afford a starter condo, a single insurance quote can end the search for good. The pressure lands hardest on those with the fewest options: first-time buyers, retirees on fixed incomes, and anyone caught between a pending sale and a lapsed policy. In South Florida, the cost of peace of mind has never been higher, and for many, it's out of reach entirely. Mortgage math has turned brutal across South Florida. A 30-year fixed loan on a median-priced condo now runs over $2,100 a month, double what buyers faced just 3 years ago. That extra $1,100 isn't a rounding error. It's the difference between qualifying for a starter home and getting locked out entirely. For first-time buyers, the dream of homeownership has shifted from difficult to near impossible. In Miami, a young couple earning the county's median household income now spends more than half their take-home pay just to cover principal and interest, before property taxes, insurance, or association fees even enter the equation. Rates above 7% have become the new normal. Lenders require higher down payments, stricter debt-to-income ratios, and airtight documentation. Buyers who stretched for a pre-approval in 2022 are now told their budget buys far less. Many have watched their purchasing power evaporate with every Fed rate hike. Each new insurance premium and every special assessment tacked onto monthly costs. For a condo once listed at $400,000, a buyer putting 20% down faces a monthly payment nearly $800 higher than in 2021, erasing the advantage of lower prices and pushing families to the sidelines. The squeeze is everywhere. Teachers, nurses, and small business owners, once the backbone of the local market, now priced out of neighborhoods they've called home for years. Some turn to adjustable rate mortgages, hoping for future relief, but most simply wait, rent, or look elsewhere. Agents report open houses filled with hopeful faces, but fewer offers. Pre-approval letters expire before buyers can find a unit they can afford. The gap between what people earn and what lenders require grows wider by the month, leaving a generation of would-be homeowners in limbo. Investors, too, have pulled back. Rental yields are shrinking as carrying costs climb. The calculus is simple. If the rent can't cover the mortgage, taxes, and insurance, the deal doesn't pencil out. Small landlords hesitate to bid, and institutional buyers shift capital to less volatile markets. For every cash buyer, there are dozens more watching from the sidelines, waiting for rates or prices to fall. The result is a market full of listings, but short on qualified, willing buyers. The affordability crisis isn't abstract. It's a daily reality for thousands across South Florida, and it's rewriting the rules of who gets to call this place home. Nearly 41,000 condos now sit unsold across Miami-Dade, Broward, and Palm Beach, a 61% surge from last year. The math is simple and brutal. 2 months ago, sellers could expect a signed contract within 3 weeks. Now the average listing lingers for 60 days, with some towers showing row after row of empty balconies. The market is flooded, but buyers are scarce and skittish. Each new listing is another plea for attention in a sea of price cuts and incentives. For agents, the mood has shifted from frantic optimism to quiet anxiety. Open houses draw more lookers than bidders, and every conversation turns to insurance quotes and special assessments. Pending deals fall apart at the last minute, sometimes over a missing wind mitigation report, sometimes because a lender refuses to fund a loan on a building flagged for deferred maintenance. In Fort Lauderdale, more than 1 in 5 contracts was canceled in July, the highest rate in the country. Buyers who stretch to make an offer face a gauntlet of hurdles. Escrow deposits, once a safe bet, now vanish overnight if a deal collapses. One couple, hoping to buy their first condo in Sunrise, lost $18,000 when their mortgage approval was yanked after the building's master policy lapsed. Their story is hardly unique. Social media is filled with posts from would-be owners stunned by the speed at which their dreams evaporated. Sellers, too, are feeling the squeeze. Those who bought at the peak are forced to slash prices, offer to cover closing costs, or throw in a year's worth of association dues just to keep buyers at the table. For every successful closing, there are 3 more listings that quietly expire. The owner's left waiting for a call that never comes. The glut has changed the rules for everyone. Investors, once eager to snap up rental units, now demand deep discounts or walk away entirely. Condo boards, desperate to maintain property values, debate whether to allow short-term rentals or relax pet restrictions, anything to fill the empty units. The liquidity that fueled South Florida's boom has dried up, replaced by a wary standoff between buyers and sellers. In this new reality, the only certainty is that inventory keeps climbing, and every failed deal leaves another story of loss in its wake. September 2nd, 2025. The National Hurricane Center's 5 a.m. advisory flashes across every agent's phone. Erin, now a Category 4, with sustained winds cresting 130 miles an hour. The storm's cone doesn't point straight at Miami. but it's close enough to rattle nerves from South Beach to West Palm. Within an hour, inboxes fill with subject lines: contract on hold, buyer requesting extension, escrow release needed. By mid-morning, the calls start coming in waves. Carla Rodriguez, a top producer in Sunny Isles, watches as her pending sales dashboard bleeds red. 32 deals under contract at sunrise. By noon, more than half are canceled or stalled. Some buyers cite insurance uncertainty, others invoke the hurricane clause buried deep in every standard contract. One couple, set to close on a waterfront two-bedroom, walks away from a $14,000 deposit, rather than risk an uninsured loss. Their lender, like dozens of others, freezes all new approvals until the storm's path clears. Developers feel the sting instantly. The related group, with 4 towers in active pre-sale, reports a 60% wipeout in new contracts. Entire floors go dark in the sales log before lunch. Title companies pause escrow releases, citing force majeure. Attorneys advise clients to hold off on wire transfers. Agents huddle in office kitchens, phones pressed to ears, scripts ready for every variety of panic. The dominoes keep falling. Condo boards scramble to update insurance certificates, but carriers refuse to buy new policies with a major storm in the forecast. Association managers send out emergency notices. Elevators locked down, open houses suspended, window inspections moved up. In Miami Beach, a high-rise pulls all active listings offline, hoping to avoid a flood of price cuts if the worst happens. By late afternoon, the MLS feed reads like a casualty report. In high-exposure zip codes east of US 1, cancellation rates spike to over 50%, 10 times the usual weekday churn. Older oceanfront buildings, already struggling with insurance gaps and deferred maintenance, see buyers vanish almost overnight. For every deal that falls apart, 3 more are pushed into limbo, buyers and sellers alike waiting for the next NHC update. The market doesn't freeze so much as seize, every moving part locked by fear of what the next advisory might bring. By the time Aaron's outer bands pushed wind gusts past 60 miles per hour along the coast, the South Florida condo market was already in lockdown. Every agent's phone lit up with the same message. Showings paused until further notice. MLS feeds stopped updating new listings east of Biscayne Boulevard. Title companies, citing hurricane clauses buried deep in standard contracts, froze escrow releases on more than 1,000 pending deals. In high-rise lobbies from Hallandale to Jupiter, association managers posted emergency notices. Elevators parked on upper floors. Windows taped and inspected. Open houses canceled indefinitely. The operational freeze swept through every corner of the market. Lenders issued blanket holds on new approvals, refusing to fund closings in any zip code flagged for tropical storm risk. Attorneys reviewed contracts line by line, searching for any language that could let buyers walk away without penalty. The hurricane clause, once an afterthought, became a lifeline. Dozens of buyers invoked it in a single morning, citing the threat of uninsured losses if Aaron veered west. Some sellers, desperate to salvage deals, offered to cover extra insurance or extend closing dates, but most negotiations ended with a single email: contract terminated, per force majeure. For agents, the mood in the office shifted from nervous to numb. Carla Rodriguez, who started the day with 16 active contracts, watched her pipeline shrink by half before noon. One buyer, a retiree from Toronto, forfeited a $9,000 deposit rather than risk closing on a unit with a lapsed master policy. Another, a young couple from Kendall, spent hours on hold with their lender, only to be told that all new loans were suspended until the storm passed. The sense of paralysis was total. Every conversation circled back to the same question: when would the market move again? Developers, too, found themselves trapped. The related group's pre-sale office, once buzzing with activity, sat empty as entire floors of contracts were voided in the span of hours. Legal teams scrambled to draft new addenda, hoping to reassure jittery buyers, but the damage was done. By the end of the day, more than 60% of new contracts in some towers were either canceled or indefinitely delayed. For every agent pacing the hallways, there were 3 more refreshing the MLS, hoping for a sign that the freeze would thaw. The storm's impact reached beyond the coast. Inland, in Coral Springs and Weston, showings were put on hold, not because of wind or rain, but because insurers refused to buy new policies anywhere south of Lake Okeechobee. The operational standstill wasn't just a coastal story, it was a regional shutdown. Triggered by a single advisory from the National Hurricane Center and enforced by the fine print in every real estate contract. In those hours, the South Florida condo market wasn't just slow, it was silent. Governor Dantis's inbox pinged every hour on the hour, subject lines stacked with urgent requests, directives, and replies from a dozen state agencies. As Hurricane Aaron's forecast drifted just east of Miami, the governor's office pushed for immediate action, pressing the Department of Business and Professional Regulation to fast-track emergency inspections and guarantee temporary insurance coverage for any stalled closing. County officials, especially in Miami-Dade and Broward, bristled at the pace. Their building departments demanded strict code compliance before greenlighting any new permits, pointing to the backlog of structural integrity reports still unfinished since the Surfside collapse. In a single morning, more than 200 emails traded between Tallahassee and county offices, each one escalating the urgency, each one met with a new set of conditions or clarifications. On the ground, the result was gridlock. State inspectors arrived at condo towers with marching orders to clear units for occupancy, while county engineers insisted on full documentation before signing off. Permit counters filled with association managers pleading for emergency approvals, some waving letters from the governor's staff, others clutching new insurance quotes that expired by sundown. In West Palm Beach, a high-rise board president described the scene as a standoff with clipboards. State teams urging speed, county officials warning that any shortcut could invite the next disaster. Developers caught in the crossfire blasted out group texts to lobbyists and local representatives, demanding a single set of rules. The Florida Realtors PAC, flush with fresh campaign donations, called for a moratorium on new safety mandates until the storm season ended. Meanwhile, the state's Emergency Operations Center sent out near-daily bulletins, reminding local governments that restoring market confidence depended on visible, decisive action. But the divide only deepened. Miami-Dade's permitting office, short-staffed and wary of liability, slowed approvals for older oceanfront buildings. Broward's code enforcement flagged dozens of towers for incomplete reserve studies or expired elevator certificates. State officials countered with legal memos, citing emergency powers and the need to restore liquidity before the next insurance renewal cycle. The volume of directives, appeals, and counterclaims ballooned, each side convinced the other was risking either public safety or economic collapse. By the end of the first week, the market's verdict was clear. Inventory kept climbing, buyers stayed frozen, and the state-county feud played out in real time. One order, one permit, one stalled closing at a time. Cape Coral stands as the cautionary tale. Home values down nearly 20% in 3 years, active listings up more than 500%, and sellers cutting prices just to get a single showing. CoreLogic now ranks Cape Coral, Lakeland, Northport, and West Palm Beach among the highest risk markets in the country for further price declines. In Cape Coral, the surge in inventory has overwhelmed the market. What was once a seller's playground now feels like a liquidation sale, with agents reporting entire condo complexes sitting idle for months. It isn't just local owners feeling the pain. Out-of-state investors, once eager to snap up Florida condos, are shifting their attention elsewhere. North Carolina and Texas, markets perceived as safer from hurricanes and insurance chaos, have seen a 23% jump in out-of-state offers since July. MLS data shows a clear migration of capital, with buyers who once fought for Miami listings now bidding on coastal homes in Wilmington or Galveston. The ripple effect is undeniable. For every Florida listing that sits, another market gains momentum. Economists tracking the fallout warn that the downturn isn't evenly spread. Miami and Jacksonville, buoyed by international demand and stronger local economies, show signs of resilience. But for most of Florida, especially aging coastal condos, the forecast is bleak. One real estate professor at Florida Atlantic University put it bluntly, coastal condo properties are going to take the longest to recover here. They are the ones that are lagging the most in Southwest Florida. For buyers, the message is clear. The days of easy money and endless appreciation are over, at least for now. Experts advise demanding up-to-date documentation on building codes, reserve studies, and insurance coverage before making an offer. In high-risk markets, cash is king, and patience is essential. For those locked into older buildings with deferred maintenance, the best move may be to hold, renovate, or rent until the dust settles. If you're considering a move, look closely at the numbers, not just the view. The market's verdict is in, risk is back on the table, and caution is worth its weight in equity. In 2021, over 330,000 people moved to South Florida, fueling a condo boom that pushed median prices above $410,000 by late 2024. But just months later, the market saw a 61% surge in unsold inventory and an 11% drop in pending sales, with average mortgage rates topping 7%. 6 major insurance carriers exited the state, forcing 1.3 million policies onto citizens and driving Broward premiums above $6,200. When Hurricane Erin was upgraded on September 2, 2025, more than half of condo contracts collapsed in a single week. Internal state emails reveal the governor's office issuing hourly directives amid political standoffs with local officials. Yet many documents detailing building safety and insurance risks remain undisclosed. Today, Cape Coral faces a 20% price decline, while out-of-state buyers shift their attention elsewhere. What remains unclear is how resilient the region's housing market will be if another storm hits or insurance options shrink further. The evidence shows that Florida's condo crisis is both a warning and a challenge, one still unfolding in real time.